We now need to turn to our maturity schedule. Recall that ASC 842 requires us to disclose a maturity analysis of operating and finance lease liabilities, showing the undiscounted cash flows on an annual basis in each year for the next 5 years and the total thereafter. We also need to reconcile this to our lease liability. So we'll change our beginning date here to January 1st, 2027. And then the first thing we'll need for our maturity analysis is the undiscounted future lease payments for the next 5 years and the total for any thereafter. So let's add another section to our disclosure information, and we'll call this maturity analysis information. Now, for the headers here, we need to think about this a little bit. We could simply populate this as the year of our maturity start date. For this first year, we need to populate this with the sum of all the remaining lease payments to be made in that year, in this case 2028. But this is a bit more challenging than it initially appears. The most obvious thing to do would seem to be to use a sum-ifs formula, and then find all the lease payments here on our lease worksheet to be made in 2028. But that presents a couple issues. One, we didn't add a column in our lease schedules for the year. So we could do something like this. And that's certainly one good way to solve this issue. But we also need to take into account that our disclosure information may not be populated for an entire year. Our reporting date may instead be for the first quarter, let's say, of 2027, in which case our ending date would be 3/31/2027. If that were the case, we would need to populate this first column in our maturity analysis with all the remaining payments in 2027. So we could still use a sum-ifs. We'd have two criteria, one for the year and another to ensure we only calculate payments after the reporting date. But we don't have that year column in our schedules, so we'll solve this slightly differently. Let's add a first year end input here. And to do this, we'll build a date. So the year will be the year of the maturity start, and then we want the last day of the year. So the month is December, and the day is 31. That will ensure our first year always ends on December 31st of the year that our maturity analysis begins. And if your fiscal year doesn't follow a calendar year, you simply need to update the month here to adjust for that. Now in our maturity analysis, our first header will instead be this first year end input. Then each subsequent year after that will be 12 months in the future. So we'll say end of month, grab the date prior, and move forward 12 months. Then finally, the last column will be all remaining payments thereafter. So now we can populate our payment information using a sum-ifs formula. In this first column, we want to sum up all of the payments on our lease schedule, and the first criteria will be the payment date, and we want to ensure that it's greater than or equal to the maturity analysis start. And then the second criteria will also be based on the date, and we want to ensure that it's less than or equal to the header date here. Then let's lock our cells here, so we always want to look in column H. We will always look up the date in column G. The criteria will always be in cell C7. Again, we'll look up the date in column G. And the ending date can always be found in row 12 here. Then for the next year, we'll do something very similar, but not identical. So we'll say sum-ifs. The sum range will again be the payments. But instead of the first criteria being greater than or equal to the maturity date, we want it to be greater than the date from the year prior. So we'll grab that here, and then the second criteria is the same. We want to ensure that the payment date is less than or equal to the header date. And now we can lock our cells and copy and paste this formula over for the remaining 3 years. Then for the remaining payments thereafter, we already have our total remaining payments here. So we'll calculate this as the remaining undiscounted payments less the sum of all the populated data from the 5 years prior. And now we can copy this down for each lease. And just like we did for the balance sheet information, we'll manually update these worksheet references with find and replace. So our first is 1.1 to 2.1, and we'll just do this quickly for the remaining as well. So now we're ready to build our maturity analysis. Let's add another table for that. So our header here will be maturities of lease liabilities were as follows. And then we'll add our reporting date here and center it over these two columns. And let's bold this and add a bottom border here. And then we'll have one column for operating and one for finance. And let's center align all of this information. And let's add a bottom border to this as well. And then I think actually we'll get rid of the bottom border for these first cells here. I think that'll look a little bit better. And then let's give this a box as well, just to make it look visually a little bit cleaner. So first we'll add our 5 years here. So the first will be year, and we'll link back to our first year end. Then each period thereafter we'll add 1 until we're at 5 years. And then we want everything else thereafter. And then let's align these to the left and just indent them a little bit for readability. Okay, and now we're ready to populate this. So we'll add a total row to each of our years in the maturity analysis. We'll copy over our formula from the long-term liability. And then we can simply link back to that information in each row here. And then we'll add a total for all future lease payments. Then the last thing we need to do here is to reconcile this to our lease liability. To do that, we need to subtract all the future imputed interest from our lease schedules. And if we've done everything correctly, the undiscounted future cash flows less the calculated imputed interest should, at any given time, equal our remaining lease liability. So let's see if that works for us. The first thing we'll do is add one more column to our disclosure information, and this will be our remaining interest. So for this, we'll use a SUMIFs. We want to sum up all of our calculated interest. Our criteria range will be the date. And we want to sum all the dates that are greater than our reporting date. And then we can lock this and copy it down. And for the last time, we'll need to find and replace to update our lease worksheet. So we'll just do that quickly. Add our totals here. And add this to our maturity analysis. So we'll say less imputed interest. Grab that from our interest calculations above. And we'll flip the sign to negative. And then calculate our total lease obligations as the sum of our future lease payments less the imputed interest. And now you can see we're calculating this correctly for our finance leases, but not our operating leases. Let's add a check to easily highlight this. So first for our operating leases, we'll round our obligation to 2 decimal places and ensure that it equals our remaining liability. And then we'll do the same for our finance leases. And then let's copy over the formatting from our checks over here. And now we can easily see our operating is not working, but our finance leases are. Now, it's not actually that our formula doesn't work. The error here from our operating leases is not a logic issue. It's because our example leases here include many lease modifications and remeasurements that we looked at in prior episodes. So our future periods as of 3/31/27 will include some of those. As an example here, you can see that for our 6.1 lease, we performed a modification in the middle of 2029, which is after our current reporting date. In practice, this would never happen. You'll be reporting information as of the reporting date, and clearly you can't have modified or remeasured a lease in the future. It's only this way because of how we've set up our lease examples and walked everything to this point. So to prove that, let's pick a reporting date after any modification or remeasurement. So if we choose 2029 as our disclosure year, beginning January 1st, 2029, and ending on December 31st, 2029, at that point we'll be past any modifications that we've made. And you can see our maturity analysis updated automatically. It now begins in 2030. And as you can see, even though we don't have payments for very long thereafter, both our operating and finance maturity schedule is accurate. So the last thing to do here is simply subtract our current obligations. So we'll add a line here and we'll say less current obligations. Link this back to our current liability up above here. And then add a row to calculate our long-term lease obligation and calculate that as the sum of our total lease obligations less our current obligations. And then we'll add some checks for this as well. So let's copy this down for formatting. Then this first one will round our long-term obligation for our operating leases to 2 decimal places and ensure that matches the long-term liability we're calculating up above here. And then we'll do the same for our finance leases. And sure enough, it's working out just as we'd expect. So I think that's enough for this episode. In the next, we'll look at our expense disclosure, and this will be quite simple. It's already all on our income statement. So we'll briefly cover that information and wrap up our series.